between claims rising, the ISM declining, remaining in contraction territory, seeing the employment data set at 43, which is, I think, the lowest of since COVID. So yeah, I think bad news is bad news. I would say, though, that we started seeing this in May, where when we started getting interest rates falling from late April of this year, when the 10-year was at 472, we started getting some bad news. It didn't really hurt large caps and mega caps, but it certainly hit the average stock, and certainly it hit smaller caps, which we saw this big dichotomy open up between large and small caps, which then quickly reversed when we got that good CPI report on the 11th of July. And that's kind of given, I think, a lot of investors a lot of confidence. And then we get this string of bad news and it kind of resets to reality.
So where are we in that reality, Mike? Because not only, we mentioned the SOM rule before, which shows that, it's a recession indicator tied to the unemployment rate. You've got your own Cantro rule as well. That's your own homegrown recession indicator. Are we there? Are we getting close?
Mine's already triggered. Mine triggered 3 months ago. And mine looks at how fast unemployment growth, so how many people are unemployed, the pace of that growth rising year on year. And when it breaks 10% historically, and just like the SOM rule, it's been similarly accurate, you are heading towards a recession, or you've always had a recession. And so that broke 3 months ago, and it's continued to rise. And again, it's just more evidence that the economy continues to kind of break down, I think, and maybe that's too aggressive a word to say, but we're seeing, despite lower rates in the last month or 2 months, housing data is not really responding positively. That's not a good sign. PMIs are not responding positively, and consumer confidence is not responding positively. So there's more breadth in this economic softness than we've seen in some time.
And I'm curious, Michael, we got another big economic data point tomorrow, right? The jobs report. I'm just interested in what your expectations are there.
Sure. I'm in the camp, and I'm a strategist. I don't necessarily do point forecasts, but I continue to think the unemployment rate is going to continue gliding higher at a modest pace, or moderate pace. And I think what investors are fearful about is a quick acceleration in the unemployment rate, not something we've seen yet. And I think there's several reasons that we won't see that. That again, it'll be more glacial in nature. Number one being that oil prices are not spiking, something we've often seen before recessions and big spikes in the unemployment rate. We still have a decent amount of fiscal spending, and we have parts of the economy that are still holding up for fiscal reasons, or even the housing sector. It's going to take more pain to break that because of the lack of inventory. So I just don't think things are going to accelerate quickly, but I think we're going to continue to see a weaker labor market. The labor market I'm really focused on is next month, when we're likely to see the post revisions, the annual benchmark revisions from the BLS, and that could lead to a major shift in what has arguably been overstating employment, which has been the birth-death model. That could see a pretty sizable downshift next month, and that's something I'm looking out for as we go forward.
Something else that you have been noticing, and we mentioned the milestone today of the 10-year yield falling below 4% for the first time since February. I know you have been noticing the reactivity to moves in the 2-year yield. In a recent note in particular, you were looking at correlations between all kinds of things and the 2-year yield, from everything from small caps to utilities to other groups here. And noticing perhaps that some of these groups, like the small caps, are taking their cue more from the 2-year yield. In other words, benefiting when we see that yield go down. And that's an inverse small cap chart, looking at it moving very much correlated to the yield. What does that imply, that the 2-year is sort of taking precedence?
I think it's just a natural shift of what was driving interest rates for the last couple of years was really the inflation and economic growth backdrop. And now that we're getting closer to the first Fed rate cut, which we agree it's in September, although I would argue I think the Fed should have started cutting already. But I think it's just the market more focused on what the Fed is going to do, more so than what the economic data are doing. What I would in that note, I more broadly discussed, though, that the last 3 weeks, not including today, much of that decline in interest rates has come from a good inflation report we had earlier this month, Whereas today we've broken 4% on the 10-year, the 2-year yield's down a lot, 5-year yields are down a lot, but that's because of bad data. And so you're seeing a very negative reaction from markets. And so when yields go down, it could still be a good thing going forward if it comes from lower inflation. But if it comes from higher unemployment, bad PMIs, bad earnings, bad macro data, while that was good news a year ago when everyone was worried about inflation, that's not the case today, and I don't think that's going to. We're going to see that as good news going forward.
Michael, I think the last time you were on the show, you were a fan of utilities. I think, if I remember, Michael, you referred to Iron Man football. That sector, it's kind of like offense and defense.
Good memory, Josh.
You still a fan?
Absolutely. In fact, while everyone's been cheerleading small caps, not everyone, but many have been cheerleading small caps for the last 3 weeks, I've been arguing that utilities is really the place to be. And as of today, as we sit here today now, utilities have actually outperformed the Russell 2000 since the beginning of that rotation, which started on July 11th. So you've been better all year being in utilities rather than small caps. They're beating them year to date. And even from this massive record-breaking move in small caps that really was 4 days in length from the 11th to the 16th, it's been utilities that have continued to work. And I think that makes sense because that's the part of the market that is much more stable, that tends to outperform when risk is rising in the economy and doesn't have the earnings and economic risk that a smaller cap companies